Mike Tedeschi, Wealth Management Advisor at Prospective Wealth Planning. I hope you guys had a fantastic Thanksgiving week. It's good to be back. We have a ton of stuff to cover in today's video, and it is going to be the tale of two different things. When we take a look at the technicals right now, the markets look absolutely fantastic. They're all pushing at those all-time highs. We'll jump through those levels here in just a second. But the second thing that we're going to take a look at here is sentiment and put-to-call ratios. We are at some major extremes. And while things look fantastic technically, underneath the surface, we have some concerns here. I'm going to lay out what those are in today's video. Now, first and foremost, let's just jump in and look right at the indexes. All right, there's not a whole lot to say here. The S&P 500 was trading in a range between June and basically November, between that 3,200 and that 3,600 level, right? Every time it fell down here, it held. Every time it ran up into here, it failed, until the last couple of weeks where we have our fresh breakout and we're putting in new highs. This is a beautiful range breakout, and technically this looks fantastic. As long as we can kind of hold over that 3,600 level on the S&P 500, things look great. We take a look in at the NASDAQ. The NASDAQ, while it was a leader for the majority of the year, over the last month or two hadn't put in a new high, right? It kind of ran into that resistance. It still put in the same type of pattern as the S&P 500, but we saw money kind of flow out of tech and into some of the more beaten up areas of the market, like oil companies and airlines and banks, right? However, we have still seen the NASDAQ being strong, and we made a new all-time high here over the last couple of sessions. So even though money flowed out of tech over the last couple of months, it's still managing to find a way to grind higher here and put in new highs. So that is bullish. We take a look at the Dow Jones. Right, we have made that breakout to new all-time highs, taking out those February zones, and we are now in between a 29,000 and a 30,000 kind of zone. Love to see this close up over that 30,000 level. That would give us that nice breakout, very similar to the other indexes where we had a multi-month range with a breakout here. So looking for that to continue to head higher as well. Now, we've talked a lot about how the Russell has been just horrible here over the last few years, not making a new high in multiple years. Well, that, of course, has changed as we put in a new all-time high, and the Russell had the best month it has had, up almost 20% in the month of November, with a clean breakout over this entire resistance range, and it continues to set up here over the last week or so in a nice high tight flag, looking for that follow through. So if we see a break over that 1862 level, that would be extremely bullish there as well. Now, while the major indexes are making new all-time highs, the U.S. dollar has been clubbed. We have finally broken down, and we have fallen below that 91 zone. All right, we put a new low for the year in when we broke underneath 4 or 5 days ago, and we have now put in a new low for the last 24 months or so. The dollar looked like it had the potential to kind of hold on and push back up, but if you remember, it failed right at this major resistance zone, and then it put in a lower high. So we have lower highs, and now we've got lower lows. This trend to the downside continues. It's been that way all year, and it makes a lot of sense considering the amount of money that was printed this year from an M2 perspective is over 20% of all U.S. dollars ever created were created this year. All right, if we're going to have that kind of printing, you would expect devaluation of the currency, and you would also expect pushing higher prices in most asset classes, and that's what we're starting to see all across the board. Now, the U.S. dollar's next zone of support really falls back into that 88 zone, right? And this whole area is that kind of support zone in from about 90 to 88 and some change. So we're going to be paying very close attention to what happens here. Let's look at this in on a monthly chart, and you can see that we really have a major floor that should hold for the U.S. dollar in at that 88 zone. The importance going back to 2009 and 2010, and then finding that breakout in 2014. A move underneath of that would target about that 82 zone there. So we're going to be paying very close attention. Break underneath it here would be really bad for the U.S. dollar. And again, that would probably lead to higher asset prices. Things priced in the U.S. dollars would subsequently go up. We take a look at the emerging markets here. Here we are, folks. A huge month out of the emerging markets. That breakout that we talked about continued to rock and roll higher. We're now just looking at that kind of resistance zone. Those highs from a few years back, they come into play up around here, so we're going to continue to watch that pretty closely. You could see something like that happen for sure. Really, the important level to hold is that 1140 zone. Should not fall back underneath of that, or that would be subsequently a false breakout. Now, let's take a look at some commodities here. We have a big move out of oil. Oil has broken up above that 44 zone. We've talked about this for quite some time, the importance of this area. That was that resistance from back in here. We're now above that gap zone, and here we are kind of trading in that nice tight range here over the last couple of weeks. A move back up over would be very, very bullish, and we're really looking for, again, that 4150 zone to hold. Our next kind of resistance zones come back in here around that 50 zone and that 55 in on oil, so those are the levels that we're going to pay close attention to. Now, the precious metals have actually been very weak considering the weakness out of the U.S. dollar. You would think a weak U.S. dollar would have been that nice tailwind there for the precious metals, and what's actually happened here is they have pulled back, but bears were not able to break this down. We were not able to break the major level of support, which we have had on our gold chart here for a while. And while we spent a couple of days in this zone, we're now back up over that 1830 zone. And so this could be kind of that potential bottom from this long pattern. We're going to have to pay close attention. If we close underneath of these lows, my thought process on the precious metals changes, but as it is right now, this just looked like a test of support after that huge explosive move we had earlier this year. Some of the precious metals look a lot better than others. Let's take a look at silver. Silver, if it was the same as gold, it would have fallen all the way back to 20 because that's its level of support. Instead, it has held that 22 line, and in fact, it didn't put in a new low, right? It held above the low put in back in September. So silver actually looks stronger than gold here by that method, and it made a very nice bounce over the last couple of days after testing that 22 zone. Right? Not out of the woods yet. Still needed up over 26 for it to continue its move higher. Now, the two best looking, well, the best looking is definitely copper. We've talked about this a lot. That is a clean break over that 330 level. Now we got to back this out to a monthly chart before we can even see the next level of resistance, because we are now trading at highs going all the way back to 2014. All right? We are all the way back to where we were now in February of 2013. So really strong move out of copper. The next area of resistance in that 380 zone. And we kind of run into this whole zone from where we broke down back at the end of 2012, beginning of 2013. That's going to be the big test for copper. But this has been a pretty incredible move here over the last few months, holding over that 3 level, acting really well. Palladium has been extremely strong for quite some time. We're watching that 2,500 level, right? If we look at this over the last couple of months, unlike gold that has put in lower lows on the pullback after that big push up, this continues to put in higher lows. So it is, once again, looking like a potential ascending triangle. Major resistance in that 2,500 level. A move over that would be very bullish for palladium. Now, platinum, which has not done well over the last few years at all. If we look at the monthly chart on platinum, it has really, really been beat up for quite some time. Part of the reason for that was the switch from platinum into palladium and auto manufacturing. So the demand kind of waned here. But it has held that kind of support zone. It's the big flush when everything was getting tossed earlier this year because of the pandemic. But you can see that 750 level goes all the way back to 2004. And that's really where we kind of put that bottom in this year. And we have pushed back up into that 1,045 range. All right, this has acted as stiff resistance in over the last 5 years. And this is a very, very important key inflection point here. A move over that target's 1,200 real quickly there on platinum. And this is a long base. So if we are going to see a breakout here, it could be an explosive kind of move here to the upside. The high for the year is 1,046. I would say a move over 1,050 would be very bullish for platinum here as we're looking at a multi-year range potential breakout. And as you can see, again, that next resistance doesn't come into that 1200 zone. So this is an area I would definitely pay close attention to. Now, let's jump in and let's talk about some sentiment. Now, we'd like to talk about that smart money, dumb money confidence ratio. The dumb money is about as confident as it ever gets up here at that 85 level. The smart money had a nice bounce off of like 13% a few weeks back, but it looks like it wants to start kind of rolling over too. So we are still really not seeing things the same between retail and institutions. And again, when things get this stretched, eventually that rubber band has to snap back. The question, of course, is when does that happen? All right, we can go for quite some time with this being very elevated, as we saw, at the end of 2019 into the beginning of this year. We had that same kind of setup, and it lasted for months. So this doesn't mean we're going to see an immediate move back down, but what this is telling us is when this tide starts to turn, it usually does so in pretty swift, fashion over the course of a couple of weeks type of move. The next thing I want to take a look at here is the small trader call buying ratio. What is incredible is the smallest traders have spent more than 50% of their volume last week buying speculative call options. This has only been exceeded a couple times in the last couple of months and hasn't been exceeded any week since the year 2000. And a change from recent weeks is they also pulled back on buying protective put options. Put buying only made up 16% of the volume amongst these traders, the lowest level in a decade. This chart here only goes up to 2006, but you can see the last time we saw this level back in 2004, and then we saw a lot of this level of speculative behavior back in 2000 and 2001. And this is why we want to pay attention to it, because this is an extreme reading level that has led to some corrections in the past. When we look in here at these numbers and we look historically at every time that we've had these results of more than optimism of 0.4, what we see is not necessarily very good. The average win rate, the highest was 3 months later with a 45% win rate. Most of these were in the 30s. And 1 year later, this is what was really the most concerning here, really positive 26% of the time. The average return 1 year later after this kind of speculative call buying has been negative 11%. It is the average return. Right? When we talk about sentiment, we like to take a look at extremes, and we are certainly at a time of extremes. People are not buying puts, they're buying a ridiculous amount of calls. Indexes are at those all-time highs, have pushed a ton from the lows this year. There is certainly a reason to be concerned. The wild card here, and the reason why when we go and we backtest all of these pieces of information, and it may not be nearly as important as it has been in the past, is we have never printed this much money this quickly. And if you're printing money, money has to go somewhere, and it is tended to go into assets. And the stock market is where that money usually ultimately ends up flowing. So if we're going to continue to print more capital, perhaps this speculative fervor of call buying will not be punished this time as asset prices continue to rise due to inflation. Or maybe this time isn't different, and we're setting ourselves up for pain at some point in the near future. We're going to continue to pay very close attention. As always, we don't need to make a change to the way that we're trading off of historical data points. The markets are breaking out to new all-time highs. That is bullish, and we're going to continue to keep a bullish stance until that changes. And the reason why we look at these data points is just from a cautionary standpoint of when that changes, we might be in for a bigger pullback than many people are expecting. But until that happens, we have to continue to go with what the charts are telling us, and the charts are clearly saying, as all 4 of the major U.S. indexes are at all-time highs, things are pretty good. Hope you guys have yourself a fantastic week. As always, I'll see you guys next week. If you want to get a hold of me, feel free to reach out to mtedeschi at perspectivewealthplanning.com or pick up the phone and give us a call at 814-580-9881. Have a good one. Take care.